Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course, help to make it actionable, understandable, and clear. What a week, and therefore what a show. 3 salient data points for us this week. We are going to be looking at the Vanguard. Was there ever a Vanguard? And I want someone to say hi. Can you say hi?
Hi,
What's your name?
Lucy Hunt.
What do you believe about investing?
Keep your costs low, your investing simple, and your time horizon long.
That is wisdom beyond your years. Thank you, Lucy Hunt. Oh, excuse me, podcasters. I have to sign. Only because she's Lucy Hunt, she can come in mid-broadcast. But we're looking at the Law Office of Patrick J. Burns, and yes, Vanguard, our beloved Vanguard. They've been doing things they shouldn't have done. Wall Street Journal article by Jack Pitcher. U.S. stocks are now pricier than they were in the dot-com era. And then followed up with Yale's trend-setting private equity strategy is getting harder to pull off. We talked a little bit about this last week. We revisit it. At the top, Vanguard. Many of you listeners know how I feel about my beloved Vanguard. Of course, the founder, Jack Bogle, one of my heroes. One of my quips is that some of the best inventions of the 20th century, antibiotics, the semiconductor, and the index fund. And Jack Bogle, while he may not have invented the index fund, there's some back and forth in his history, he certainly popularized it and brought it to the mainstream so that you and I can purchase this product. It was known as Bogle's Folly when it came out. He started the firm as a mutual fund company. What does that mean? It means that there aren't shareholders that are desirous of a profit. The actual mutual funds are the holders themselves, meaning when they get more assets under management, they lower the cost. So costs get lower as assets increase. Kind of operates like a credit union. Listen to this. Our beloved Vanguard has to pay a civil penalty of $19.5 million and cease and desist from committing or causing any violations and future violations of yabba. Now, what happened? This is something that I've been looking at because our beloved Vanguard, they're beginning to act like their neighbors, the rest of the world, losing some of their distinctives. I still think they're the best, but listen to what they did. They do have their own advisory services now. You can go and sign up to be a customer of a Vanguard Advisors, PAS Advisors, and they'll charge you typically 30 basis points, 0.30%. And my experience has been they do a decent job. They'll put you in good index funds. And I say decent because they've got some high-priced products they're now promoting, and then they can sometimes overcomplicate things. But by and large, I actually think they're one of the best. If someone tells me, gosh, I got to have someone that can hold my stocks and trade on my stocks, I don't want to do it myself ever. I say, Vanguard's is pretty good. But listen to what they're doing. From August of 2020 through December of 2023, Vanguard Advisors Performance Review System incentivized its advisors that serviced PAS advisors to enroll and retain those clients in PAS. So they were making money to sell this product. And I'm curious. I'm at Vanguard myself, and occasionally I will have a product pushed on me, and I'll kind of wonder to myself, is the advisor making money here? Is this a commission deal? I didn't ask, but I usually would ask, these are these folks that are supposed to be helping you at Vanguard. And I just do wonder. I wonder. Now, as a consumer, this is one of my favorite things to do and help clients with. Answer the question, what does it cost? In the years that I've been doing this, I forget if it's 8 or 9 years, everybody that comes in here who's with an existing advisory relationship, if I ask them, hey, do you know what your financial advisory relationship costs you each year? They don't know. And it's understandable why they don't know. It is very difficult to ascertain what the actual dollar costs are to you because there are product fees in the mutual funds and there are these assets under management fees. Well, there are disclosure documents that none of y'all will ever read. I think the industry needs reformation in this area, but there's an ADV form. I don't expect you to ever care about or know about ADV form, but you can think of it like a required disclosure for pricing. And Vanguard had an ADV form that was supposed to detail all the conflicts, all the areas where they were charging, and they didn't. So this is what's why it can be so hard to be a consumer today. You're going to the very best, which is Vanguard. You're trying to do the right thing. You think you're clicking the right button, and wouldn't you know it, you're getting sold a product. And the person on the other line is getting bonused for the product they sell you. So it's not that safe place we thought it was. Hence, my advice to you and my advice to anyone who is able to do this, not everyone is, but find yourself an hourly financial advisor. Find that advisor. The advantages, in my mind, are quite clear. You get alignment. Charlie Munger, the late, great Charlie Munger, once said, you show me the incentive and I'll show you the outcome. So if Vanguard wants a bunch of people signing up for this PAS advisors, you know what they're going to do? They're going to bonus their people. And so you might go to Vanguard and, oh, what is going on? All these people are just trying to sell me on this product. Is it because they really think it's best? Or are they getting bonused? The best system that I've found is hourly, because it really makes transparent what you're being charged and what the deliverable is the advisor is offering to you. So get on the Google machine. If you want financial advice, find an hourly advisor. The best advisor is going to be yourself. Second best, if you have a spouse, is your spouse. Third best is an hourly advisor. And ultimately, I think that hourly advisor is an important part of the team, even if you are a hotshot personal finance nerd. My experience is, if you're normal and human, there's always going to be a growth area or a blind spot you need help with. On to the Wall Street Journal. Jack Pitcher writes this article, headline, U.S. stocks are now pricier than they were in the dot-com era. When I read this is an August 31st article. What in the world? Price in the dot-com era? He says the S&P 500 has never been this expensive or more concentrated in fewer companies. Bum, bum, bum. So what are you supposed to sell? Here's what the article says. The S&P 500 currently trades at 22.5 times its projected earnings over the next 12 months, compared with the average of 16.8 times since 2000. And we can do some definitional work. When they say this, what does it mean? You're paying 22.5 times. It means for every dollar of earnings, you pay $22.50. So you are paying up per dollars of earnings. And why would that be? Well, let's read the article. Many investors say the biggest U.S. stocks, most of which are technology companies, are worth every penny. This is what makes a market, listener. Buyers and sellers mutually agreeing. Companies such as NVIDIA and Microsoft are boosting sales and profits at a rapid pace. They dominate the market. Here's where people try to scare you. The 10 largest companies of the S&P 500 accounted for 39.5% of its total value at the end of July, the most ever, according to Morningstar. 9 have a market capitalization. Definitional work. It's the total number of shares times the share price. That's market cap. It's a nice way of saying if they sold every share, what would it be worth? 9 have a market cap over $1 trillion. That's trillion with a T. A T. Steve Sosnick, the chief strategist at Interactive Brokers, says, I'm not so worried about the concentration. The big question is what can happen if the situation changes? Harrowing again. The combination of very high valuations and very crowded trades certainly raises the susceptibility of the market to an extended downturn, Sosnick added. If everyone is effectively long the same things, where do the marginal buyers come from when they fall? Wow, we got to talk about this, don't we, class? Into the classroom. What is Mr. Sosnick saying with respect to Mr. Sosnick? Well, he's trying to scare us, not intentionally so, but he's being candid. He's saying, oh, high valuations, that's that PE ratio we talked about, how expensive it is per dollar of earnings. Crowded trades, what does that mean? It's his way of saying a lot of people are putting money in the same stocks, which that's what the index is. Okay, fine. When he says, where do the marginal buyers come from? Well, not your problem, not my problem. It's a market. And this very argument could have been made 5 years ago. Listener, did you know what I heard 5 years ago? In 2020, the harrowing COVID year, what did I hear 5 years ago? Market's too concentrated. Market's too expensive. This is the correction we'd all been waiting for. Thank you, Fern. I've got a dachshund that agrees. This is the correction we'd all been waiting for. What good did it do you, listener, to go to all cash and during COVID? Well, hindsight's 2020. You bring the children around the radio on this one. Of course, that would have been foolish. But that's only because you know how the story ends. It is not so easy. It is not just pitch and catch. I think as stocks climb, you will have more folks writing articles like this with warnings of what to do. There's a group, Mr. Mark Giambrone, who's head of U.S. equities at value-focused Barrow Hanley Global Investors. A lot of wonderful folks in Dallas that have worked for that firm or currently work for that firm. He says he's seen plenty of attractive opportunities for investors willing to look beyond mega cap tech. Now, when he says mega cap tech, he's talking about Google and Apple and Meta and these large NVIDIA. So his firm is favoring businesses that might be able to benefit from artificial intelligence with increased productivity, but don't yet come with AI company valuations. But what do you have to believe? What do you have to believe about the market in order to take his advice? I don't believe it. Do you, listener? What he's saying is, oh, certain stocks are efficiently priced. These other stocks are inefficiently priced. But what do we know, listener? What does that SPIVA report say? SPIVA? 95% of these active funds will fail to beat the index over a 10-year period. Over a 20-year period, the data is even more favorable toward index funds. So whenever someone starts trying to spook you about concentration in an index or price to earnings ratios in an index, you just close those ears and go full ostrich. Stick your head in the sand. There are a whole host of reasons why that really doesn't matter and you shouldn't think too much about it. But one of them I'll just give you is if you look at a large company like NVIDIA, who is now the largest company by market capitalization in the stock market, it's not just one business line. There are lots and lots and lots of business lines that make up that one company. And same with Apple, same with large cap tech Google. Oh, sure, it's one ticker symbol. But Berkshire Hathaway is one ticker symbol, and look how many companies they represent. Doesn't spook anybody to own Berkshire, typically. So take heart, indexer. Don't listen to the naysayers. Investing fads will come and go. There will be a season where large cap tech is favored, and they may be right. I don't know. Maybe large cap tech falls out of favor. You know what lasts forever? Cost lasts forever. And every new idea I just gave to you by either Barrow Hanley or Interactive Brokers or anyone else, you know what it does? It costs more than 3 basis points, 0.03%, which is what Vanguard's charging. Actually, Vanguard's charging less than that. But that's the purported rate. So be willing to focus on what we can control, and that is cost. Cost. Bogle has a great quote when people would push back on his efficient market hypothesis. That's a hypothesis that says that all available information is inputted into the stock price, and therefore there's not a lot of misinformation for you to take advantage of as an investor. Now, I think we can all agree, maybe sometimes that's true, sometimes it's not. We just don't know. But what he says is efficient market hypothesis, whatever. He has a cost matter hypothesis. And I think that's the right way to look at it. And what Bogle says is right. What matters is that you can control cost. I have no clue which strategy over the next 10 years will work. Small cap value, small cap growth, small cap blend, mid cap value, large cap. We're going international, domestic, China, Brazil, US. I don't know. You know what I know? The funds with the lowest cost will do the best, all things equal. So let's just do that. And finally, back on our Yale topic, Heather Gillers writes, Yale's trend-setting private equity strategy is getting harder to pull off. Sub-headline, universities and other institutions have built up large private equity holdings, but they are now lagging behind the S&P 500 and aren't easy to shed. You hear that last part? They're not easy to shed. For those of my listeners who are invested in private equity and know when interest rates rise, it can be a more challenging environment for them. A lot of these Ivy League endowment funds are experiencing that. So the article begins, universities, pensions, and foundations have piled into private equity for decades, hoping to match the blockbuster returns of Yale's legendary endowment chief, David Swensen. You remember my Swensen quote from last week, where he says, on an after-tax, after-fee basis, there's almost no way to beat the index fund. That's Swensen. That's the creator of modern endowment theory saying that. He sadly died from cancer in 2021, but he produced an annual return of 13.1% during his 36-year run at Ivy League school. Listen to that. 36 years, he produces a return of 13.1%. That's not just good, that's really good. But 13.1, do you ever hear people promise you big returns, 20%, 15%, 25% on an individual deal or a fund? One of the best in the business, he did 13.1. It's hard. It's really hard to get great returns over a long period of time. But what's happening right now? Private equity is lagged behind the S&P 500, and high interest rates have really made things tough for the private equity business, where you borrow money and you invest in equities. So Swensen benefited from a declining interest rate environment, where a lot of these funds were able to take advantage of things. But now they've trailed stocks for 3 years in a row, according to Wilshire Trust Universe Comparison Service. 10-year annualized returns at many Ivy League schools last year fell to their lowest point since 2019. So Yale's saying we're going to stick with private markets. They say, we trust that sophisticated investors, don't be offended, listener, they don't think you or I are, but they say, we trust that sophisticated investors, especially our partners who know us best, understand this, the school said. Private equity holdings, they fit into a broader strategy, yada, yada, yada. So it has really been a laggard for a lot of these folks. And what's been tough is it's been complex. So I mentioned this last week. If you have an endowment fund, a pension fund, and you have a ton of exposure to private equity and you need the money, not easy. Whereas publicly traded securities, boom, click of a button, liquidity is for you to be had. So when they try to sell these private equity stakes, which is something Harvard and Yale are trying to do, they typically have to negotiate and settle on a price which is less than the value of the fund on paper that the fund manager set. And this is an interesting quote. This is a former Yale manager, Sullivan. See, I don't like this attitude. Listen to this. One of the reasons we hire these guys is because they know when it's the right time to sell an asset, said Sullivan, the former Yale manager. We don't know how to do that. What? I'm not even sure what he means by that, but if I were to interview him, I would just say, knowing when to sell an asset purports that you can market time. And the great Warren Buffett quote is, he's never met anyone who's market time consistently, and he's never met anyone who's market times consistently. So what should you do? What should you focus on? Oh, you almost took the words out of my mouth. You should keep your costs low, your investing simple, and your time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.